All right. All right, it's about 5 after the hour, so I'm going to get started. If you just came in, my name's Jeremy Kogan. We're the Blockchain Institute. Basically, what we do is teach blockchain. We're a public charity that makes courses like the one you are about to see. And this one today that we're covering is Demystifying DeFi. There's this whole big buzz going around in the crypto world that the next big thing is DeFi. It's tough to argue because, as you're going to see, we're talking about an ecosystem that has something like $45 to $50 billion locked in right now. So DeFi is already a thing. It's still rapidly growing. It's being figured out, but it's at the point where I would say everybody should be learning about this because it's a thing already. People are putting money into this. People are seeing gains from using decentralized finance. We're going to go over all of that. So the goals of this course, 5 main ones, and there's also several running themes that we're going to go over. So what we're going to cover is the road from Bitcoin to Ethereum to DeFi, basically how we got from the creation of Bitcoin, the first blockchain, to Ethereum to DeFi, how traditional financial applications are being decentralized, the values of the DeFi ecosystem, which include openness, modularity, decentralization. We'll go over that one by one. The new financial applications being built upon blockchain technology. So what people are actually building using DeFi and the results of that, and also how to navigate the DeFi ecosystem using various tools. That's our walkthrough, hands-on part. We'll teach you how to do things like starting from using MetaMask all the way to making your crypto available for other people to take out as a loan while you're receiving the interest. So there's some pretty cool things with DeFi. One more note, this is actually designed to be a course that directly follows our Crypto Curious course. That's just the basics of all things blockchain. So if you took it, great, you're in a perfect place. If you didn't take our Crypto Curious course, you're probably still all right as long as you know what a blockchain is, the basics. Corey, if you could put that link in the chat, though, for people that want to go back and look at the first course, they can have the opportunity. I very much appreciate it. So let's talk a little bit about DeFi. Why are we even here? Why is DeFi a topic of interest? Well, as Bitcoin established a form of centralized money, or decentralized money, excuse me, it's the first time we saw any form of decentralized money. People are starting to explore new innovation trends to see if decentralized finance can function. So finance is different than just money transfer. It's a whole variety of different things. So people are coming to the Bitcoin blockchain saying, wow, this is really good at transferring money. Could we actually build a financial system from this? And that's the whole question surrounding DeFi. So there's some specific properties and characteristics of DeFi. What makes DeFi DeFi? It's a looser term, but there are certain traits shared by the different applications, decentralized applications working in the DeFi ecosystem. The first is that it's open, second, modular, third, decentralized, and fourth, independent. So we'll go over these one by one, see exactly what they mean, and that'll actually give us a decent picture of what DeFi actually is. Openness. One of my favorite things about the DeFi ecosystem, it's open to everybody. Everyone that has an internet connection can get a cryptocurrency wallet, interact with it, and now, because of this whole DeFi ecosystem is coming up, they might have options to financial solutions that they didn't have before. So Bitcoin was the first cryptocurrency, and it gave any internet user the ability to transfer funds across borders. And that was a huge deal for certain areas that didn't have reliable mechanisms to do that. Also, it's much cheaper than typical money transfer on average. some areas just aren't covered by basic financial services still. We're going to get into that a little bit later, but if you give people an internet connection and an open system where they can participate in finance, and that's really their only way to have a financial system, it's a good argument for using DeFi. So in most areas, banks have really disproportionate control over who can use your services. Banks pretty much run the show when it comes to that. So it makes sense from a legal perspective. Banks basically have to make sure they aren't doing money with criminals. But there's a lot of people that have just been excluded because the profit motive of banks isn't extended to those areas. Those areas have basically been deemed they don't have a lot of capital. It's not good. The banks have decided it's not good business for them to expand into those areas. DeFi turns this concept on its head. All you need is an internet connection, a little bit of knowledge, which you all will have by the end of this class, and you can participate in the DeFi ecosystem. DeFi, it's also modular. And this is one of the more unique aspects because a lot of people think software, they think it's closed systems, people guarding their secrets closely, proprietary information. DeFi is different. Remember, everything on a public blockchain, everything that's built on a public blockchain, which a lot of these DeFi applications are, is open. It's open. It's basically everyone can see what's going on. Transparency is a huge part of blockchains. So DeFi is modular, which means that creators can use different parts of previous innovations to create something completely new. So the reason you see the building blocks on your screen, made by our wonderful graphic artist, Jason, made all these awesome images. DeFi applications are basically pieces or the whole piece of another application put together. So let's say you're trying to create a new tool, but you like two previous tools that exist, and maybe you want to merge them. You can do that because everything is transparent, everything is open source, basically. And you can you can pick and choose from previous innovations to create your own. This is super, developers tend to really like this because, hey, you can create something using building blocks that are already established to make something completely new. Very modular, can add what you want, have pretty much unprecedented control and options when creating a decentralized application. And of course, DeFi is decentralized. And you might have guessed that the D in DeFi stands for decentralized. So a couple notes on decentralization. We went over it in our previous course. That's a CCC that the link is in the chat for. DeFi relies on decentralized networks, and that includes the lack of a central administrator. So nobody's really running the show. Governance by protocol instead of somebody running the show. The rules are there for everybody to follow and enforced automatically. And also decentralized systems are able to establish scalable trust. So basically, you're not relying on a bank or a middleman to create the trust in order to facilitate a transaction. That could be in the form of fees, the price of creating a contract, etc. So the protocol basically, instead of trusting somebody and then bringing in different parties to make sure that they hold in their end of the bargain, this doesn't happen in decentralized systems. Both people trust the protocol. The protocol can take the job of the middleman, thus saving both people more money. It's very important to understand the context of that everything arose in. Bitcoin was definitely a response, very much so, to the 2008 financial crisis. The rise of DeFi is also a direct response to the overly centralized nature of our current financial systems. So access is restricted, and decisions about the financial well-being of the average person are made by a few select individuals or groups in positions of power. So to provide proper context, we're going to go over it a little bit. We go over this more in depth in the Crypto Curious course, but 2008 hit, and the United States spurred a global financial crisis. There was many reasons. It was kind of a perfect storm leading up to it of negligence and just poor practices and risky practices. Basically, it took a domino effect. It started a domino effect with all these big institutional investors, investing institutions and banks basically failing and not being soluble anymore because they made a bunch of bad bets. So we were in this horrible financial crisis, and we basically had a decision. Should the government bail out the banks through a huge stimulus package, or should the government let the banks fail, have them figure out their own, possibly creating more turmoil? So to avoid more possible damage, the government ended up bailing out the banks. There were arguments for and against. People basically said, hey, if we don't bail out the banks, it's going to throw everything into more chaos. People are going to completely lose their life savings and have basically nothing that they originally had in the bank beyond some typical FDIC insurance. The other option was to bail out the banks, and this was ultimately the route it went, but this wasn't without criticism. Because the banks were bailed out, a lot of people were worried about something called moral hazard, which is basically like if the banks didn't feel a negative effect, would they engage in the same risky behavior if they knew that, hey, we were bailed out last time, maybe we'll just get bailed out again. And this has kind of happened to an extent. The banks didn't really reform a lot, and a lot of the bailout money actually went to CEOs, executives, retirement packages, bonuses. But it would have been very difficult to let the banks fail. So we rely so much on banks. DeFi, somebody described DeFi as cutting out the banks and adding a blockchain. So the decentralized protocol basically takes in the role of the bank. And we're going to talk about how that happens. So DeFi allows for certain types of transactions that typically needed a bank to be conducted. There's a wide variety of reasons that these institutions were given this exclusive privilege, why they kind of manage this whole thing. One is the liability that banks undertake when allowing people to use their services. Again, you're going to get huge fines if you're letting criminals use your services for money laundering. Another main reason for banks controlling these services is because they historically were a third-party institution that had the required capital to facilitate these loans in different forms of finance. So they provided value in the form of establishing trust between two other parties wanting to conduct a transaction. So somebody wants a loan, somebody wants to make their money available for a loan. The bank is the mechanism that basically bridged that to make it happen, while obviously taking their cut. Banks have almost had a monopoly on being these trustworthy institutions. Also had the capital to provide banking services. So really, you need a lot of funds in order to facilitate these transactions. That really is why historically banks have been the big, powerful institution that you need to go to get loans. So the creation of Bitcoin opened up some avenues for finance. It allowed two strangers to conduct a transaction without the need for any entity to come in or facilitate the transaction. And when that happens, normally when you bring in third parties to help make sure that transactions go through off the web, they're going to want to get paid. So these transactions get more and more expensive, the more and more trust has to be established. So we have these decentralized protocols that Bitcoin Proof works. So the question is, if banks are not needed to establish trust and individuals have the capital that allows them to conduct transactions that were previously restricted to investment institutions, well, why are banks needed? And DeFi says, you're right, banks aren't needed. We're just going to automate the role of the bank and have it take less money out of the transaction. That's the idea behind DeFi. Users trust the protocol and then can offer loans and other financial instruments based on that protocol. So trust is established through rules protocols that are transparent to everyone, the technology to kind of go around banks and facilitate these loans without them exists, and it's rapidly gaining in terms of applications, money, and users. So DeFi has sparked a lot of optimism, but why is this innovation now gaining traction? What took so long? Put simply, a series of events and technological advancements needed to happen in order to spark what has become the decentralized financial system. We needed to clear certain hurdles, create certain things to make DeFi a reality. So in this next section, we're going to examine how DeFi came to be, starting with going back all the way to the creation of Bitcoin. So here is a section break, and here is my opportunity to check out to see if anybody has any questions. Looks like there isn't now. I got a couple more people that were added to the chat. Looks like we got 36 going. That's a pretty good size class. Looks good. All right. If there aren't any questions, I'm going to move along. If anybody has them, just remember, throw them in the chat. We have a bunch of these section break slides. And every time you get to one, I'm going to be checking the questions. Let's get into the limitations of Bitcoin. Limitations of Bitcoin, you'll see, was a huge impetus in spurring innovation past Bitcoin. Bitcoin was the first blockchain, certainly wasn't the last. And a lot of those blockchains were iterating off of the Bitcoin model in order to make things go a little bit more smoothly. So let's examine Bitcoin's purpose. So in our previous course, that Crypto Curious course, we talked about the innovation that is Bitcoin and how it happened. We talked about how it allowed for peer-to-peer cryptocurrency transactions, and there's really no doubt that Bitcoin was the trailblazer in the cryptocurrency space. But did Bitcoin fulfill its stated goal? As by Satoshi wrote in his writings, he wanted a decentralized peer-to-peer digital cash system. Did Satoshi satisfy this requirement set forth by themselves? I'd argue yes, and then some. Not only did Bitcoin prove itself to be a viable way to transfer value, it arguably became a much better way to send value around the world than existing cash transfer systems. When people send money across borders, they usually do it through a bank or a money transmitter like Western Union here or MoneyGram. This process can take several days and often comes with exorbitant fees. It's way too high. With Bitcoin, the same scenario might take up to an hour to transfer that value, if the network is somewhat busy, and a fee that's most likely going to be under $1, no matter how much Bitcoin's being sent. Basically, it's a better money transfer model than anything that has already previously existed. So these large entities that existed before decentralized, and actually currently exist, but did business before the creation of Bitcoin, could charge these exorbitant fees for their inefficient services because there was no other option. People would they were stuck using their services. They had essentially cornered the market and had no incentive to further innovate because they were just raking in money. These banks and money transmitters were just happy to be collecting a check. So that's why the introduction of Bitcoin was so interesting. It introduced competition into an industry that previously had no challengers. And competition is usually pretty good for the consumer. For the first time, banks weren't the obvious option to send money, especially across borders, and that was due to Bitcoin's introduction. So people started to ask a question that would become very important. This is a recurring theme as well. What if blockchain technology can do more than simply transfer cryptocurrency? What if a blockchain decentralized technology could be extended to process data, both financial and non-financial? What if we could build decentralized programs on the blockchain? What would that even look like? How would we do it? Well, through a handy tool called smart contracts. At this point, when Bitcoin was first introduced, it didn't have the price it has today. It was trading at cents, then a few dollars, and then it obviously exploded over time. So despite the relative lack of value compared to today, those early days definitely proved one thing about the Bitcoin ecosystem, even when it was cents, that Bitcoin, the concept, the construction of the network, could work. It could work as a way to transfer value digitally, basically fulfilling the requirements that Satoshi put out for their creation. So rarely do people look at an innovation lead it be. There's always people trying to improve, even upon the newest of innovations, seeing how far they can take it, and Bitcoin was absolutely no exception. So the early years involved a lot of exploring of what Bitcoin could be. We're going to get to that before, but a lot of that had to do with how these applications would be built upon a blockchain. And weirdly enough, the answer to this question already existed. It predates blockchains. The late 1990s, a concept that would become known as smart contracts was introduced by computer scientist Nick Szabo. So the decentralized world kind of went back, looked at a concept that had been previously introduced, but couldn't really be created because we didn't have the technology previously. And now that we did have that technology, hey, this whole smart contract idea that was introduced in 1998 could be applied to current blockchains. Funding and instructions are provided. So a network of smart contracts can be used to form a dApp or decentralized application. That's what dApps are made up of, smart contracts. The best real-world analogy to a smart contract would be a vending machine. It's one of my favorite examples. It's the illustration you see in front of you. So smart contracts are able to execute a directed action that they're programmed to do if they are properly funded. And this is the exact same situation as using a vending machine. So after you enter in your money, you punch in the corresponding number that will provide your desired snack. So that's you providing funding paired with a special set of instructions, the code. And then the vending machine functions autonomously. Doesn't need somebody to press a button and say, okay, it's okay to dispense this snack because we receive funds. It's all done automatically. These traits are actually shared by smart contracts. So smart contracts are decentralized programs that are given a specific function that they can carry out themselves, as long as they have money and instructions. Instead of trusting a third party to provide a service that is needed, the protocol can be trusted because everybody can see what a smart contract is. It's transparent, code is right there, which means that anybody can audit it, say, okay, let's look for some security vulnerabilities. Is this a reliable thing to use? Yes or no? And then people can go from there. So there were some limitations that Bitcoin ran into that spurred innovations of other blockchains that were slightly different. So Satoshi Nakamoto was very clear about his intentions for the Bitcoin network. We previously went over those. Peer-to-peer decentralized digital cash. So as mentioned before, Bitcoin met this goal and is actually still doing so. It's doing so today. It's a robust, resilient network that facilitates the transfer of value in a quick and inexpensive manner. However, some looked at the blockchain technology underlying the network and obviously, or as we talked about before, wondered if it could do more beyond simple transfer of value. So Bitcoin was faced with a choice. The network was reaching capacity in terms of its transaction throughput. Then this was way back in the day when Bitcoin was being created. The network was becoming clogged and it would result in increasing fees. And since protocol changes are decided by the network, Bitcoin users a few years down the line were faced with a choice. And that had to do with how to best organize data within each block as to make the network more efficient. So there's something called block headers, and the obvious solution was to decrease the size of these block headers, the data size, which would in turn reduce the data processing burden on the network. However, this would really limit Bitcoin to cash transfer, which would be difficult to build upon because of the amount of data that each block could hold was limited. So basically, they said in order to make things more efficient, we're going to restrict the amount of data within the block headers. That has the side effect of making it pretty hard to build upon the Bitcoin network just because of that restriction of data. So developers that recognize this difficulty of building upon Bitcoin quickly explored other options, first on the Bitcoin network, then by creating blockchains of their own. So despite Bitcoin's success, there were inherent limitations when it came to developing upon the Bitcoin blockchain. One of these key limitations was the amount of data that could be held in a block, as we were just talking about, along with the fact that Bitcoin aimed to confirm a batch of transactions just once every 10 minutes. That's how often transactions go through in the Bitcoin blockchain on average. Smart contracts containing data and blocks are limited by how much data they can hold. So developing complex smart contracts on Bitcoin was made more difficult by these lengthy confirmation times. And these data constrictions and long confirmation times led others to explore, hey, how can we make the system more efficient, possibly expanding the scope of what Bitcoin did beyond simple money transfer. So these technological shortcomings that kept Bitcoin from advancing, they were noticed by several other projects, and each were looking to innovate using decentralized technology. Many new projects decided to create their own forms of currency or even their own blockchains in order to improve upon the established Bitcoin protocol. Some of these technological changes included the number of coins that would be made available, so overall supply, transaction times, the use of non-fungible tokens. We're going to get into that in a second because those are actually really hot right now. And the creation of blockchains designed to run decentralized applications specifically, not just provide cryptocurrency transfer. So the years after Bitcoin launched saw rapid innovation. The technological standard for blockchains obviously was set by Bitcoin, but now other projects for the first time were looking to iterate off of the decentralized peer-to-peer cash system in order to apply blockchain technology to things beyond simple money transfer. The first example of this was something called colored coins. And colored coins were the first attempt at creating a non-fungible token. And if you're here in this course right now, hearing about non-fungible tokens, your timing is really good because non-fungible tokens, along with the development of this course, they kind of coincided. Non-fungible tokens are in the news right now. They're being explored heavily, and colored coins was actually the first example or the first attempt at creating non-fungible token. So one Bitcoin, this is actually a question we used to get all the time, not as much. One Bitcoin can be divided into smaller units. You don't have to buy one Bitcoin. You could buy 0.1 of a Bitcoin, even less, a tenth of a Bitcoin, 1% of a Bitcoin. So one Bitcoin can be divided into smaller units, which is useful considering Bitcoin's high price. It wouldn't be practical if you can only transfer a whole Bitcoin at once. So like any viable currency, a single Bitcoin can be divided into change, these decimal places. And without this functionality, a peer-to-peer cash transfer system simply wouldn't be able to function properly. It would basically be like trying to pay for a product worth $20 with a $100 bill without the ability to get any change back. It doesn't work. So Bitcoin had to be divisible. So when developers looked to add other functionalities to the Bitcoin blockchain, one of the first things they incorporated were units known as colored coins. And these were Bitcoins, but they were different than normal Bitcoins. Developers realized that if they could create tokens that could not be divisible or non-fungible, that they could do so in order to represent real-world assets or digital collectibles that cannot be divided. So non-fungible tokens can't be split up to represent assets and collectibles that can't be split up. For example, you wouldn't have multiple tokens represent the deed to one house. You would need a different type of token, a non-fungible token, in order to represent non-divisible assets. This could be accomplished, and the Bitcoin blockchain could function as a decentralized digital asset manager. Spoiler alert, it didn't work out. The Colored Coins project hit a lot of limitations, mainly due to the limitations that Bitcoin, the chain itself, hit. The project ultimately stalled, and a lot of the developers ultimately would go on to different projects. One of those projects that looked to build in concert with the Bitcoin blockchain, kind of run in parallel with it, was Mastercoin. So some developers knew the limitations of developing upon the Bitcoin network. They wanted to add another layer to the existing Bitcoin protocol in order to facilitate the more advanced capabilities that would ultimately lead to DeFi. So this question was explored all the way back in 2013 by a project known as Mastercoin, as you see on the screen in front of you. Its goal was to create a robust, decentralized digital economy that could utilize the capability of smart contracts. So they were basically adding an extra layer to Bitcoin that would be able to process smart contracts. That was the goal. So the attractive idea behind that is you have Mastercoin running in concert with Bitcoin. You don't have to change the Bitcoin protocol. Mastercoin kind of exists and plays within that protocol, but it was more of a situation where Mastercoin was being molded to Bitcoin than vice versa. The only problem was that Bitcoin, since no protocol changes were being made, could not properly govern the actions of Mastercoin. So users could possibly manipulate the Mastercoin network. Additionally, there was a dispute within the community that Mastercoin could sufficiently house and deploy smart contracts. And ultimately, the project would kind of stall and rebrand to Omni. However, there were a few other blockchains that would be introduced. One of the cooler early blockchains, or not blockchains, because this was built on actually the blockchain we're going to discuss next. One of the cooler projects was Basic Attention Token and Brave. They kind of go hand in hand. So one of the earlier innovative cryptocurrencies based on Ethereum, which we're going to talk about in a second, was the Basic Attention Token. This project dedicated itself to addressing the whole publisher, advertiser, viewer, internet relationship. So the current system abuses personal data and doesn't reward users for paying attention to ads. That flipped this concept on its head. Instead of advertisers throwing an ad at you and hoping you would watch it, the project introduced more interactive ads that could prove that you were paying attention to the ad, you were interacting with it. And as a result, that Basic Attention Token can be paid to users who interact with ads. Additional cool feature was that BAT gives users the ability to reward their favorite content creators by tipping them in the cryptocurrency. Brave and BAT are still around. We're actually going to go over Brave a little bit when we talk about surfing the decentralized web. So all these deficiencies were pretty glaring and would ultimately be addressed by a project known as Ethereum. So after seeing the complications with colored coins and Mastercoin, the challenges of expanding the Bitcoin protocol towards a financial platform looked to be a very difficult task. So in 2015, a group of like-minded developers, led by Vitalik Buterin, created a decentralized computing platform that could effectively process data without the use of a central server. Game changer, process data in a decentralized manner. This would become this blockchain would come to be known as Ethereum. So these developers, including Vitalik, were motivated by the lack of ability to create smart contracts and extra capabilities on the Bitcoin blockchain. After participating in projects such as Colored Coins, it became clear that in order to reach the goal of decentralized computing and development, a new blockchain would have to be created. Smart contracts were too much for the existing Bitcoin blockchain, especially at that point. But what if there was a blockchain specifically designed for development of smart contracts and decentralized application? So in 2015, the Ethereum project was launched to tackle that exact problem. I'm going to take a second, look in chat, see if anybody has any question. Let's see. Any questions in here? Oh, somebody asked if the session is being recorded and if they'll be able to access it later. Yes, you definitely will. That one was a direct message to me. And to the person that put that in the private chat, I will make sure that you get a copy. But yeah, we're going to make that option available. No blockchain related questions. Looks like we are going good. All right. Moving right along. This section, we're going to get more into Ethereum. Ethereum was pivotal because it shifted the focus from processing simple financial data, or excuse me, cryptocurrency transfer, into processing data on a blockchain, completely decentralized manner. So we alluded to this a little bit. There were certain limitations with Bitcoin. What spurred the creation of Ethereum? So it's absolutely true that Ethereum was greatly influenced by Bitcoin. I mean, Bitcoin is the first blockchain after all. But the advancement of both projects are linked in interesting ways. Ethereum was largely an advancement in blockchains that was inspired by some of the perceived deficiencies we went over when it comes to Bitcoin. So Bitcoin was the pioneer that paved the road that is blockchain technology. Ethereum would act as a tool to allow development on that paved road. It's my favorite analogy. We're going to get into exactly how that works. Ethereum started with a few simple ideas. Vitalik was just 19 years old at the time that he started exploring this prospect. Had a fascination with all things crypto. This led Vitalik to work on the Colorcoins project, which he eventually stopped working on when it became kind of apparent that the Bitcoin blockchain could not fully support the project. So during this time, a team was formed to Ethereum. So in 2013, Vitalik wrote a white paper proposing a wider conceptual version of the blockchain concept. So Buterin labeled his concept as Ethereum and suggested that it would provide greater utility than Bitcoin by allowing block data to include executable code, which peers could run for each other in a completely decentralized computing environment. That might seem a little complex, but don't worry, we're going to get into what that means. Also, cryptocurrency known as Ether would help support the network by providing economic incentive and could act as a way to conduct simple cryptocurrency transfers as well. So rather than the blockchain existing as a ledger of transactions, Vitalik proposed that the chain might instead serve as kind of a source of communal truth for the results of computations. That's the big difference. Not just transactions, but actually executable code and the computation that results from it. Instead of value being transferred in the form of coded data, why couldn't data be processed in a decentralized network with many equal participants? In order for this to happen, Ethereum would have to add a component that could effectively process data in a decentralized manner. This functionality that was limited in Bitcoin because of how much data that could be processed. So you had to add an extra component in order to make this work. So in this new version, the network of peers collectively would send data to be processed in the form of transactions, while communal ledger recorded the results of these transactions. The rules of this transition and functionality are encompassed in, they're all laid out in the Ethereum protocol. And the group of peers that are referred, that are responsible on the network, and it's everybody that's responsible in the network, it's kind of divided up amongst the peer-to-peer network. The decentralized processing of that data is known as the Ethereum virtual machine, or the EVM. So the Ethereum virtual machine isn't one entity. It's comprised of the collective members on a network. While it isn't a single entity, it uses the power of the participants on the network to help process data. So the ability to process data in a reliable and quick manner allows for developers to build applications upon this decentralized platform. And of course, applications built on a decentralized platform are known as decentralized applications or dApps. dApps function as normal applications would, but instead of relying on a central server that could fail or compromise private information, they rely on Ethereum's decentralized network and the EVM in order to execute user actions. Servers are really good at processing data, but there is this inherent security risk and lack of transparency that has led to the rise of an ecosystem where today security and privacy are paramount. People are finally starting to value those aspects. And while the EVM isn't the most efficient way, it's not as efficient as a server in processing data, which server is like the king. It carries out actions like that. EVM might not be the most efficient way to process information, but it does so in a decentralized manner that prioritizes security and equality. So because the EVM is in an open system, there are subs where anybody can use. There is risk of somebody coming in and trying to subvert the network by just running code which just repeats itself into oblivion, just wasting network resources. So a mechanism had to be added to reduce this spam. And you might be saying, hey, this kind of sounds like fees in the Bitcoin network. It's exactly what it is. But in the Ethereum network, Ethereum blockchain, they aren't called a fee. It's called gas. And what gas is, you need to purchase gas to fuel the EVM in order to execute your transaction. So it's a fee, but it also has the utility because it also has utility because it works as spam prevention. So in order to prevent anybody from spamming the network, a pricing unit known as gas must be paid in order to run these computations. Got to put gas in the EVM, otherwise it's not going to work. And gas is purchased at the time of a transaction when a smart contract is triggered, or when a smart contract is triggered, and must be paid for in Ether. So because the price of gas can vary independently from the price of Ether and will increase when many people buy it simultaneously, provides an economic disincentive that prevents spam. It's basically going to cost you money if you want to spam the network. Another thing that the Ethereum network did that was big difference from Bitcoin. Bitcoin's block time of 10 minutes was reduced to just 10 seconds in the Ethereum network. And these faster processing times or confirmation times allow for the quicker processing of data. It's this characteristic that allows Ethereum to act as a functional decentralized platform, because when you're using decentralized when you're using dApps, you're basically having that dApp constantly communicate with the chain. And it just would be really slow and inefficient if this was only happening every 10 minutes. It'd be like one click, one web page every 10 minutes. You basically need a lot quicker of a block time in order to avoid this issue. Basically, if you want to process data in a decentralized manner in an efficient way, Ethereum realized they would have to decrease the block time from 10 minutes, and they did so significantly. A new batch of transactions is confirmed roughly every 8 to 12 seconds in the Ethereum ecosystem. And that's just done to make dApps run more smoothly. so dApps can communicate better with the main chain. And here is actually, I'm going to go back to the Zoom and look for questions real quick, because this is actually the first interactive part of our course. No questions. All right. Oh, looks like we're almost up to 40 people. That's awesome. If anybody came in late, super excited to have you here. So talk about MetaMask a little bit in the previous course, Crypto Curious course. MetaMask is a dApp that connects, it basically acts as a wallet that also connects to the decentralized web. So MetaMask allows you go over the decentralized. Looks like I cut out, so I'm going to go over MetaMask again really quickly. So MetaMask is one of the dApps that connects a wallet to the decentralized web. The best way to describe it is a bridge between your regular browser and dApps. It's a tool that allows you not to just serve dApps in your own browser, but also interact with them and pay for actions using a wallet. There's a wallet mechanism to MetaMask. And that is what we are going to go over right now. First, we're going to talk about, hey, I have this hardware wallet, and this might not apply to everybody. People keep their Ether in different places. If you do have a hardware wallet, it's extremely easy to add to your MetaMask. Get your cryptocurrency from your hardware wallet to your MetaMask. So start over at the top, this little icon over here, and then you go to connect hardware wallet. Pretty easy. At this point, you have the capability of 2 hardware wallets, or you have the capability to link either of 2 different hardware wallets, and these are one of the most popular, and these are some of the most popular ones. You have the Ledger, you have the Trezor. You basically, whoops. Basically, you just select which one, and it'll connect your hardware wallet to MetaMask. You'll be prompted on the hardware wallet in order to send cryptocurrency over to your MetaMask. So click one, you would have your hardware wallet plugged in. Once you click connect, you'll be prompted on your hardware wallet. This doesn't apply to everybody. Some people might just have Ether in a wallet, and it's actually really easy to add that Ether to MetaMask. It's a simple transfer. So here you want to go to, this is a little counterintuitive, buy. You're not buying, but what you're doing is depositing Ether into your account. So you click buy, click deposit Ether. Right here, what comes up is a QR code, which is derived from your address. And you can use either in order to fund your MetaMask account. So let's say I have money on a wallet on my phone. I would use that app on the phone just to scan that QR code and send cryptocurrency over to my MetaMask. Easy enough. So once you have Ether in your account, hey, you can transact using some Ethereum. That's what I'm going to do in this example. And it's pretty easy. You just go, I don't know if anybody saw that, but you click on the send button. And then you want to add your recipient, basically the address that you are sending your cryptocurrency to. And I just had one copied and pasted. It'll ask you to select the cryptocurrency that you want to transfer, Ether in this case. Then it'll have you select the amount of Ether you want to transfer. Something interesting here, I clicked my max and it says I have insufficient funds. Why would it do that if I'm putting in the max amount? Well, if you look at the next line over here, there's a transaction fee that's ultimately added on in addition to the amount of Ether that you're sending. So you gotta send a little bit less ether. Can't send all of it because you need to pay for gas as well. So I'm going to send a little bit less so that I don't go over my limit. And there you go. That's confirmation. I sent it over to that wallet, and over here is the pending transaction. Something cool, you can speed up a transaction if it gets stuck. We're going to go over another way how to fix that in a minute. But basically, let's say your gas fee was too low and the price of gas went up rapidly. You could be in a situation where your transaction gets stuck, and that allows you to add some gas to your transaction or to push it through. So another way to do this as well. So let's say you have one of these stuck transactions. There is a variable in your wallet known as a nonce. Basically what that does, it orders the transactions in your wallet. So basically, let's say you have a stuck transaction. Because of some fears of something called a replay attack, you cannot send another transaction to be processed while you have that first one in limbo. So basically what you have to do is manually reorder the nonce, the order of these transactions, to add a little bit more gas before you send the main transaction. We'll go over how to do this a little bit. So we went over in Crypto Curious course how to examine a transaction receipt, and there's a variable listed on that transaction receipt called a nonce. So if your transaction is stuck, you want to note the nonce that of the stuck transaction, because you're going to have to replace it in order to have another transaction jump it. So you go over here, you go over to advanced options, you go over and turn customize transaction nonce on, save. And then next time I go to send a transaction, it will ask me to put in the nonce that I want. So let's say the nonce of the stuck transaction is 4. I would basically, for the transaction where I'm just sending a little gas, I would put in the custom nonce as 4. So the wallet knows to process that before it, basically reordering your wallet or the transactions in your wallet. It's a great way to make sure things get unstuck. That is that's the first interactive part. We're going to get into some more cooler DeFi stuff in a second, or a little bit later in the course, excuse me. But that's the basics. That's how you get money in your wallet. That's how you send a transaction, and that's how you troubleshoot a stuck transaction. So how does Ethereum and DeFi play off of each other? How do they go together? So the ability for Ethereum to act as a platform for decentralized applications has made it the go-to development sandbox for DeFi applications. So these dApps are built in a modular, collaborative way, like we talked about before, with open source software being the norm for DeFi apps. The open source nature of the software plays a big part in the development of the ecosystem. All smart contracts that govern these dApps are transparent, and anybody can audit that code and then either incorporate that tool or feature into their own project, or create an even better one using what is already established. So how did we get to DeFi? How did we get from the creation of Ethereum to DeFi? It was actually quite the journey. There were a lot of different dApps that had to be tried in order to get to a point where we created certain innovations that would make DeFi possible. So in 2015, Mike Hearn, a developer named Mike Hearn, launched Lighthouse, and that was a decentralized crypto crowdfunding application. So Lighthouse touted that it made the process of decentralized crowdfunding possible by utilizing smart contracts on the Bitcoin blockchain. And Lighthouse was a hit. Users were eager to help fund development of projects that they believed in, or even help specific charitable causes. However, it soon became clear that the Bitcoin chain was limiting Lighthouse's capabilities. So Lighthouse's popularity was also kind of its downfall. It exposed its limitations. and this is actually a recurring theme with blockchain-based projects like colored coins, they are limited on the platform on which they are built. So while the Bitcoin network could utilize smart contracts to facilitate crowdfunding, it worked, but it was heavily limited. So Lighthouse was able to facilitate fundraising using smart contracts on the Bitcoin network, but the limitations of the Bitcoin network caused issues. Block sizes and confirmation times of the network essentially limited how many transactions could be conducted daily for the crowdfunding. It's a limiting factor. Since more data was required to utilize a smart contract as opposed to a simple transaction, Bitcoin blocks could only conduct so many of these crowdfunding transactions before their data limit was reached. So Lighthouse kind of ran into this issue, and creator Mike Hearn eventually became convinced that large-scale crowdfunding could not be achieved on Bitcoin. He also predicted the scaling issues that Bitcoin would face later. And Mike Hearn would ultimately go on to work on some Ethereum-based projects as well. It just became clear to developers that other decentralized technologies had to be created, had to be explored in order to create the cool dApps that people wanted. So Ethereum pretty resoundingly solved the crowdfunding problem. And this whole issue occurred around the time that Ethereum would be launched. The next few years saw massive growth on the platform. And one of the areas that it excelled in happened to be crowdfunding. Ethereum was, as you'll see, became a huge crowdfunding, a way for these cryptocurrency projects to raise funds. So the crowdfunding model eventually turned into a way for new projects to initially distribute their tokens through a crowd sale. And this process was known as an initial coin offering. It was basically a play on the concept of an IPO. It was an ICO. With so many tokens that they were being created, projects were looking for funding in exchange for the tokens that had just been released. So there were so many tokens being created, and there were often, actually, on Ethereum, several ICOs in a single day. It was a point where there were like 5 happening every single day. So Ethereum's block structure and quick confirmation time had made Mike Hearn's original goals a reality. Through this ICO funding model, decentralized crowdfunding was proven to work. And definitely worked. 2017 saw over 1.5 billion raised via Ethereum-based ICOs, causing massive growth in the platform's popularity. So this alternate fundraising method allowed projects to skip the traditional venture capital route, instead valuing a decentralized funding model where they would sell a new token directly to people that wanted to invest in their project. And these events coincided with a time where we saw a lot of dApp growth on the Ethereum network, which makes sense because, hey, people were throwing money at these ICOs, and once the funding was complete, hey, time to build something. One of the more interesting decentralized applications would become known as NFTs. And NFTs were basically Ethereum's, ERC 721 was basically Ethereum's answer to the NFT problem. While color coins attempt to address and create NFT on the Bitcoin network, this standard right here on the Ethereum network basically allowed for the creation of non-fungible tokens. So we discussed that the Color Coins project ultimately lost momentum, but that did not end attempts to make a non-fungible token. Some of the first test cases of non-fungible tokens actually occurred when some municipalities decided that they wanted to digitize paper records, mainly the deeds to a house. And these paper records, normally kept in storage places that aren't digitized, just made sense. So something that really proved the concept that, hey, this non-fungible token thing, maybe the collectible representing real-world assets on the blockchain, there was a certain dApp that kind of set the stage for that. And you might guess that it has to do with digital kitties. CryptoKitties more specifically. CryptoKitties was a dApp that facilitated the transfer of ERC 721 non-fungible tokens in the form of collectible kitties. So each cat had a unique set of features based on the transaction hash. So the data behind the NFT actually influenced how the kitty would look. They might have different color eyes or different ears, something like that. And people were actually, it got to the point where people went crazy for CryptoKitties. People thought this was the coolest thing ever. These digital collectibles that could be paid for in cryptocurrency. Decentralized community absolutely went crazy for this idea. And the unintentional result was that the Ethereum network's ability to meet real-world demand would be tested. So the network was not quite ready for the challenge. Basically, the popularity overwhelmed the network. The months that saw the height of CryptoKitty popularity posed the toughest challenges for the network. So backlogs occurred, fees went up, the network slowed to a crawl. This made a couple things clear. The first is that NFTs had proven themselves to be useful in terms of tracking non-fungible collectibles or assets. The second was that the network still had a lot to do in order to avoid these backlog problems, in order to scale to meet real-world demand. A key innovation that pretty much had to be, and this is something that's shared with NFTs, key innovation that had to be created in order for us to get to a DeFi ecosystem, stablecoins, along with NFTs. These are huge players in the current DeFi ecosystem. They basically make it popular. So what is a stablecoin? So despite the ICO craze, many projects would ultimately go under. They became insoluble, and a big reason for this was a lot of these projects decided to keep their cryptocurrency in a wallet, not diversify and not turn it back into a fiat cash. So they were holding and relying on a highly volatile asset, and there were big crashes in 2018. So when that happened, basically the funds that these projects had dried up, and a lot of them had to hang it up. So cryptocurrency prices experienced wild swings during this time, big drops, routine to see the market swing 20% either way. And the companies that kept their holdings as a volatile cryptocurrency ultimately would be left with a fraction of the funding they once had. So people said this is a problem, relying on holding these volatile assets. It's an issue. So an advent of a different type of cryptocurrency looked to solve this problem. Instead of creating a speculative asset with a fluctuating price, this new digital currency was designed to hold a specific value, which was usually pegged to one United States dollar. So stablecoins, they don't have a varying price. That's what makes them different. They're a cryptocurrency, but and they can be traded for cryptocurrency, but they eliminate the volatility that cryptocurrency holders in these projects were exposed to. And we are actually going to dive into stablecoins and DeFi. It's our next section here. So I'm going to keep my word and check the questions and answer any that are over in chat. Somebody asked what the difference is between gas price and gas limit. Gas price is what it sounds like, the price that you'll pay per unit. Gas limit is the amount that you can set. You could basically say, hey, I don't want to exceed this gas limit. If the transaction is going to exceed that limit, don't let it go through because I don't want to pay too high of a fee. So you put a gas limit in your transaction. If it's exceeded, the transaction won't go through. And that would basically just mitigate the possible insane fees that you have. And specifically, somebody else took that an extra step, looks like in chat, and says gas limit is the amount of computation required to process a specific transaction. But you can also set a hard limit in order to basically limit how much gas that you want your transaction to use. Is MetaMask a kind of wallet, Mohammed asks? MetaMask is a type of wallet. It is a cryptocurrency wallet as an extension, but it also allows you to browse the decentralized web. So it has both of those functions, but you kind of need both because if you're interacting with dApps, you have to pay for these operations. That's awesome. Looks like we have people talking in chat as well, answering each other's questions. That makes my job easier. So thank you all. And it looks like there we go. We'll move right along and get into stablecoins. So the rise of cryptocurrency has led us to the question of what role it could play in our everyday lives. While blockchains have proven to be reliable transaction networks, the cryptocurrencies associated with them may experience vast price changes in a short amount of time, 10 to 20% in a day. In order for cryptocurrency to gain widespread adoption in a business setting, merchants and corporations need some guarantee that there will likely be some stability in the value of the cryptocurrency they are accepting and holding. Simply put, merchants aren't going to accept a currency that is not likely to hold its value. So for this reason, a new type of cryptocurrency, known as stablecoins, have been introduced. They were first introduced by BitShares in 2014, but there's many different stablecoins now, many different characteristics of them as well. These coins are pegged to a specific value. The goal of a stablecoin isn't to speculate and have its price go up. No, a stablecoin's price is going to stay stable. It's specifically designed to take the volatility out of the cryptocurrency experience, excuse me. So in order to understand what stablecoins are and how they work, we'll need to look at why there is a need for them in the first place. So the goals of stablecoin, I alluded to this before, is to limit volatility. We mentioned the problems with holding and exchanging these volatile assets, which cryptocurrency is. Stablecoins offer a consistent price, which provides the peace of mind and security that might propel new investors into the cryptocurrency market. Additionally, stablecoins might gain users from economies experiencing cryptocurrency volatility. Some people are wanting to avoid that. Some people might not want to hold some people might not want to hold a volatile cryptocurrency, yet still be in the cryptocurrency ecosystem. A lot of people might just say, hey, why not just cash out your cryptocurrency for your local fiat cash? Buying cryptocurrency is much easier to do with an onboarding step, with this intermediary step. Difficult to directly buy cryptocurrencies with fiat some of the times. So stablecoins act as a bridge to make this process more efficient. Instead of converting all your money back to fiat because you're worried about volatility, you can convert your cryptocurrency to a stablecoin and be assured that it's going to hold its price without leaving the cryptocurrency ecosystem. So when you want to go back into a cryptocurrency position, easy enough. So the frequent price changes we see in digital currency market has definitely slowed down the mass adoption of cryptocurrency. People see these huge swings and are like, I don't want any part of that. But if you introduce stable coins, that kind of limits that concern because, hey, if you're worried about volatility, just convert your cryptocurrency to a stable coin until you want to convert it back. It's very interesting to see from the different perspectives of who would use stable coins, because different parties use them for different reasons. For example, a merchant that is accepting cryptocurrency to buy a good that they're selling might be worth $1 at the time of purchase, and then that value might decline 50% overnight, and then the merchant's stuck with 85 cents on the dollar. So volatility has the potential to disrupt business operations especially for smaller and medium-sized entities. So it makes sense for a merchant that's accepting cryptocurrency to say, hey, as soon as I get this cryptocurrency, I'm going to convert it all to stable coins because I don't want to deal with volatility. Some might want to deal with a little bit of volatility. They might say, hey, 95% of my cryptocurrency putting in stablecoins will leave the other 5 in a volatile cryptocurrency because, hey, it might go up. It's an investment. So that's a merchant perspective. Investors' perspective, also interesting. Investors are constantly trading cryptocurrencies. They might not want to leave their assets in their value in a volatile asset. An interesting geopolitical, economic application of stablecoins. There's been some economies that have been dealing with hyperinflation. Turkey, Venezuela is the best example. Stablecoins have actually been a godsend for some people. It's really helped them out because their currency is basically worthless. So they are often just interacting in cryptocurrencies because really that's the best way to transfer value right now because their currency isn't worth anything. So stablecoins could allow people that are experiencing hyperinflation to have a steady asset that isn't available through their fiat money. The only problem with this is if you have a viable stablecoin being introduced into an economy, it might actually accelerate the hyperinflation because you have a bunch of people leaving the currency and getting into cryptocurrency. But hey, that's an already messed up situation. I wouldn't say that the introduction of cryptocurrency into that equation really makes that more complicated. Something interesting, there's different types of stablecoins. Not all stablecoins are created or backed in the same way. It's actually 3 types. You have asset-backed, backed by dollars, and crypto leverage. So let's go over each of those one by one. Currency-backed. That is exactly what it sounds like. You have a stable coin that represents $1, and there's a dollar in a vault somewhere that is backing up that stable coin. So that's what gives a stable coin value in this case. The money that is held in reserve that represents each one of those currencies. So basically what that says is fiat backs tokens on a 1-to-1 ratio. For every unit of currency held, there is 1 token issued. And when the token is exchanged for fiat, they're taken out of circulation. When somebody wants to buy the stablecoin, their fiat is sent to the reserve, and new coins are created and issued. So basically, you're creating and destroying supply in order to keep a volatile price. It's not how most cryptocurrencies work, but then again, stablecoins have a different purpose than most cryptocurrencies. It's getting tougher and tougher to find stablecoins that are purely backed by currency. A lot of what you're seeing is stablecoins backed by a mix of currency and assets, and some are just purely asset backed. Digix Gold is a good example. Digix Gold has been around for a little bit. Some stablecoin creators have decided to use valuable assets to back the value of their token. For example, Digix has released the Digix Gold token, and for each token that exists, each token is backed by a gram of gold in a vault in Singapore. Gold is a notoriously stable asset, but since the asset can still fluctuate, you have more fluctuation in asset-backed stablecoins compared to the currency-backed and the ones actually leveraged by cryptocurrency, which is kind of a weird thing. Yes, you can actually use cryptocurrency to back a stablecoin. How is this done? Very carefully with intricate ecosystems. Might seem like an impossible prospect considering the volatility of cryptocurrency. Projects have created these advanced ecosystems that have actually proven to maintain a relatively stable value, even though the price of Ether or other cryptocurrencies have pretty much crashed previously. That's obviously not the case now. It's made more than a full recovery. So to ensure some more stability, this type of stablecoin is usually backed by the more stable cryptocurrencies, mainly Bitcoin and Ether. And to further ensure price stability, cryptocurrency-backed stablecoins can often be backed by more than one cryptocurrency. If you spread your backing assets among several cryptocurrencies, there's less of a chance of experiencing overall volatility. You're basically diversifying your holdings. So if one part of your holdings crashes or decreases in prices, the other ones might stay more stable, and you have less volatility to deal with and contend with. The solution, what really makes this possible, is a practice known as over-collateralization. Instead of a fiat-backed stablecoin that's backed by one-to-one token-to-cash reserve, crypto-backed stablecoins are often backed by a greater than one-to-one token to cryptocurrency reserve. So simply put, since cryptocurrency is far more likely to fluctuate than fiat currency, the reserves have to amount to more value than the tokens in circulation, just because you have that ability or that prospect that cryptocurrency prices will decrease. And that actually, the amount that you have to put in order to establish one unit of the stablecoin, that actually varies depending on some automatic feedback mechanisms in the smart contract network. Best example of this is MakerDAO. It's an Ethereum-based project that uses two volatile cryptocurrencies to stabilize a third. So basically, MakerDAO uses Ether and their Maker token, MAKER, in order to stabilize the price of a third cryptocurrency, DAI, and that's DAI. One DAI equals $1. Important to notice. Important to note. So despite this somewhat complex ecosystem, DAI, its goal is to remain at $1 United States dollar. It's actually been battle tested. Like I mentioned a couple times, in 2018, cryptocurrency prices got rapidly inflated and then ultimately rapidly decreased. When that happened, DAI was only decreased to 93 cents and it quickly returned to $1. So DAI, the concept of DAI is battle tested. And a key reason of that working, why it works, is over collateralization through loans. We talked about this just before. Basically, you're putting in more value than is being put out in the that is being returned to you. And that's just to account for the volatility of cryptocurrency. So the amount of Ether that has to be staked in order to create a DAI token, it's actually variable. Usually it's about 1.5 Ether to create the equivalent dollar amount of one DAI. So for example, 150 worth of Ether can be leveraged to create $100 worth of DAI with this 1.5 collateralization ratio. And if that price begins to fall, the amount of Ether required to create DAI might be decreased in the hope that more money will be injected into the Maker ecosystem. Maker token is used to pay for feeds on the network. It isn't mineable, and the token supply is managed in order to stabilize the price of DAI. And it's the same with NFTs, but stablecoins were an innovation that basically had to happen in order for DeFi to occur. There had to be a stable, non-volatile aspect for people to be even interested in the financial application, in expanding a DeFi ecosystem. And we are almost at a section break, but before, we're actually going to teach you how to turn ETH into DAI. And the cool part is there's different ways to do this, but you can do this all within MetaMask. MetaMask will actually shop around different decentralized exchanges, which we'll cover a little bit later on, in order to find you the best price in order to exchange. So what you're doing here, go back there really quick. You're clicking on the swap on your home. Swap from, you select your asset. I'm going to swap 0.1 ETH into DAI, and it should pre-fill the amount of DAI. Actually, it doesn't. It's going to get my quotes first. So I'm putting out there, I want to turn 0.1 Ether into DAI, and it is checking, it looks like 7 total decentralized exchanges. to find me the best price. Since it's DAI, it's probably going to be, they're all going to be similar, but it automatically comes up with the best exchange rate and gives me an option to swap. I do that, it processes, and hey, my Ether gets turned into DAI. That's pretty easy. MetaMask makes that aspect just very simple. It's integrated. The swap, you can also swap from different cryptocurrencies as well. Doesn't necessarily have to be a stable coin. It just has to be a ERC based token, and there has to be Zoom questions. Somebody asked, and this was Mordecai asked, are all stable coins created equally? Are they pegged to the US dollars? What sets them apart? Most are pegged to the United States dollar or the euro, a couple of them. What sets them apart is how they are backed. Who manages the reserve of fiat currencies for stablecoins? It depends. If it's a decentralized system like Maker and DAI, it's no one. It's just all protocol. The collateralization rate changes and everything. Stablecoins like Tether are more centrally managed. So you have this Tether organization taking in money and then printing in the corresponding tokens. Do stablecoins guarantee to never decouple from the value of the asset backing them? I don't think it would. I don't see a scenario where it would. Let me think of that. Let me think about that more. I'll try to address that at the end of the course. Yeah, Tether. See, the price of these stablecoins, there is a little variation. If you look at Tether, which was one of the first stablecoins, it's mainly it's cash and asset backed. It actually sometimes it'll be $1.01, sometimes it'll be 99 cents, but it sticks pretty close to the dollar. And actually, Mark mentioned that Tether was in court regarding whether they had backing for their token. At first, people thought that Tether had cash backing for their token, and then Tether was like, "Oh no, we don't have that. We all have a mix of cash and assets." And I think I'm not quite sure where that lawsuit ended. Question: how do I compete a transfer from my bank account, MetaMask, to DAI in my bank account? You're probably going to need to purchase cryptocurrency first. Doing so using a bank account, probably going to have to go over to Coinbase or one of the bigger centralized exchanges in order to do that. So you kind of have to take the intermediary step to buying cryptocurrency. Mordecai, check out CCC, the previous course, because we do talk about how to do that. But yeah, you're going to need that intermediary step in order to purchase cryptocurrency and then get it into your MetaMask. Properties. Okay, and let's get into properties of DeFi. It's the more fun part of the course. Looks like we're an hour and a half in. So there's a lot of ways to break DeFi down, but I've broken it down into kind of 3 specific categories that makes up DeFi. They're the properties of DeFi. So first is decentralization, the second is finance, and the third is technology. All 3 were key components that were needed in order to reach the point that this growing industry has gotten to. So this section is going to examine the unique properties of DeFi and how they came together to create a fair, robust, decentralized financial ecosystem. Of course, DeFi is decentralized. So DeFi, the whole idea behind it, there's several ideas: cutting out banks, giving users unprecedented control over their financial activity. DeFi also takes financial instruments and services that are traditionally offered by banks, these big centralized entities in real life, and The whole idea of DeFi is taking these traditional financial applications and taking it to the decentralized world. And it's cool because normally in the centralized world, you need banks to facilitate these actions, and banks cost money and so do their services. In a decentralized world, you don't have to worry about that. It's nice. So these decentralized protocols, no centralized administrator. Instead, the network is governed by a set of transparent rules, also known as protocols. It's really cool because you get to eliminate trust from that equation because you don't have to use a bank. Both people are just trusting the protocol. It's saving them money on both ends because you're not paying for the services of extra third parties that, hey, now that we have these this DeFi thing set up, we don't really need them. DeFi is open to all. So banks have acted as gatekeepers traditionally. They were the only ones allowed to administer certain services and products. And a lot of that was because, hey, they were the only ones that had the capability, the capital, the infrastructure in order to do so. Something interesting, there's no single point of failure in DeFi applications. So there's no administrators who decides who will be part of the network. The answer is no one. The answer is everyone can be part of this network. Blockchains are decentralized, egalitarian software that anyone can download, run, and join the community. Simply download and run that program and download the blockchain's history. You're a node. You're part of the network. For most people, this alternate financial system is really like a luxury. We, in America, despite all the issues with banks, we have a pretty steady financial system. Could be a lot worse. There are places around the world that don't have access to basic financial services. So this decentralized technology is specifically designed so that every person could participate. I think I'm looking at these stats over here. It looks like about 2 billion people on the planet are considered underbanked, and 1 billion have access to no basic financial services whatsoever. So you're just looking at savings. Hard to get a loan there. Just lack the financial infrastructure. DeFi is censorship resistant. So the transparent nature of a blockchain and the lack of a central administrator means that there's no party controlling what transactions can go through and what can't. This gatekeeping role is traditionally filled by banks, just doesn't exist in DeFi ecosystems. And we actually have seen banks censor purchases or stop them from going through, and banks sometimes have a legal obligation to not do business with certain entities. But we've also seen banks and payment processors actually just stop legitimate transactions from going through. Specifically, this was happening a while ago when they're still trying to figure things out, but banks weren't fulfilling the purchases of cryptocurrency. And this wasn't because cryptocurrency was illegal, it's just because the banks didn't want to. This just coupling it with this open to all idea. An open DeFi system using blockchain technology doesn't just provide some guarantee against censorship of valid transactions. It also provides an opportunity for those who have been disenfranchised from banking services to participate in a financial ecosystem, albeit decentralized. And there's obviously a financial aspect to DeFi. That's the Fi part. But DeFi has recreated the financial system we're used to in a way that connects users without the use of a central entity. As a result, the investments that have traditionally been reserved for banks and certain individuals are now available to the average cryptocurrency user. So this new innovation of DeFi has opened up a whole realm of possibilities for how we can conduct necessary financial services. And these new financial instruments that have been traditionally reserved only for banks and select investors are now being brought into the cryptocurrency world, which is pretty cool. Finance is a very general term. There's a lot to that field. A variety of the features of the traditional financial system are being introduced to the crypto ecosystem. When people ask me what finance is, I like to say it's using your money to make more money, making your money work for you. Now, when people ask me what DeFi is, a lot of times I will tell them that it is making your cryptocurrency work for you in order to gain, in the hopes of gaining more cryptocurrency. So DeFi has given users the opportunity to bypass these decentralized systems. Instead of letting their fiat money work for them, they now have the option where, hey, I don't have to grow my value specifically through the real world fiat assets or fiat currency. I can do so in this DeFi system. Important term that everyone should know. The term assigned to investing your cryptocurrency for growth is appropriately known as yield farming. Yield farming has quickly become one of the most intriguing aspects of the developed DeFi ecosystem. As we just discussed, there's a major focus on people using their cryptocurrency for activities in the hope that it will grow. Basically, applying it to DeFi, using these DeFi tools in order to make more cryptocurrency, often in the form of interest. It's important to notice that DeFi can be done, or excuse me, yield farming can be done in a variety of ways. Lots of ways to grow your crypto. It's just an umbrella term for using your crypto in the DeFi ecosystem in order to garner a yield. So many specific activities that are considered yield farming, and this can range from simply making your crypto available for trade or lending to taking out a variety of leveraged loans in order to gain a return on your original investment, or even combining those two aspects. It can get pretty complex, but it can also be pretty simple. We'll show you how simple it can be in a minute. The most creative yield farmers use tactics such as margin trading and a series of loans and lending activity in order to garner consistent returns. But more and more users are entering into cryptocurrency space and doing simple things like making their cryptocurrency available for swap and passively making interest off of the cryptocurrency they've made available. A major tool that makes this work, liquidity pools. Liquidity pools fill the role of the capital providers, usually filled by banks, by allowing users to lock their funds into smart contracts, making that cryptocurrency available for other people to use or swap. And DeFi cuts out the bank's role in our financial system by connecting users via decentralized network. Cuts out the bank as the middleman. Might seem counterintuitive, but DeFi services aren't conducted on a peer-to-peer basis. Really doesn't make sense. Let's say you want to trade a certain amount of Ether for some DAI. The swap only occurred on a peer-to-peer basis. You basically have to find a person or multiple people that together would want to trade the corresponding amount of DAI that you're looking for and agreed upon exchange rate. Basically have to pair up an exact match for what you were looking for. The way decentralized exchanges handle this problem is with an innovation known as liquidity pools. So instead of users being directly matched in order to find the liquidity normally provided by banks, these pools act as the holder of available capital for others to utilize. So you don't have to find someone directly to issue a loan to. You can provide your cryptocurrency to a liquidity pool. It sits there until somebody wants to use it, and you gain passive interest on the cryptocurrency you made available. We're actually going to teach you how to do that in the next slide. Just one more thing about liquidity pools before we do that. Liquidity pools provide the necessary available funds in order to make trades and other DeFi activities possible. They provide liquidity, after all. They're made up of smart contracts that can lock up funds made available for swapping or lending while keeping track of whose funds are in the smart contract and rewarding a corresponding amount of interest. These pools provide the DeFi ecosystem with the necessary capital in order to bring these financial activities to cryptocurrency. And I looked before we started, it looks like currently in the DeFi ecosystem that's locked up in the amount of money that's locked up in liquidity pools is just short of 50 billion currently. So again, DeFi is arrived, it's already a thing. And there's lots of liquidity already in the ecosystem. What if you want to add your cryptocurrency to a liquidity pool? MetaMask and a exchange known as, or liquidity provider known as Uniswap allows for this to be done. So before we get into specifically how to add liquidity to a pool, got to look over here. That is my MetaMask address. And one of the cool things about the Uniswap app, in your browser, it'll automatically sync with your MetaMask, and all the funds that are in your MetaMask wallet can be interacted with over here as the liquidity provider. Sorry about that. So all you got to do is create a pair. Excuse me, you're not creating a pair, you're adding liquidity to an established pair. You want to click add liquidity. I want to add some Ether to the liquidity pool. So I'm going to put in 0.08 Ether. And this is important. If you select a token, let's say I want to use DAI. So I'm going to select DAI. It automatically pre-fills the amount so that these two are equal. Remember, it's a pair. The reason liquidity pairs exist, you need some type of balance when creating a pool. You don't want people just adding a bunch of one cryptocurrency. It's not a market. You have to add both sides of the market. So 0.8 DAI or 0.8 ETH at this point equaled roughly around 56 DAI. I had a balance of 69 or just under 70. So all you got to do is approve DAI, say, yeah, I want to do that, and then swap. Or excuse me, not swap, and then add to liquidity pool. Supply. You'll be given a token. It'll read something like ETH DAI wrap token, liquidity token. That token basically acts as your redemption when you want to go and claim your cryptocurrency. Remember, you get all this cryptocurrency back when you want, along with the interest it provides. And that's how you would redeem it. A token that can be kept in your MetaMask wallet. That's really convenient. We'll teach you how to remove liquidity in order to get your cryptocurrency back with interest as well. Here's the second part of that aspect. You click supply. And right there, those are the tokens I was talking about, ETH DAI pool tokens. That's your redemption tokens. Determines what share of the pool you get. And I didn't put a lot of ETH into the pool, or ETH/DAI into the pool. So it's a very small amount, but I haven't checked, but I've already made, in a few short months with, that amount of value, I made like 20, 30 bucks of interest already just for making my crypto available and letting it sit in the pool, which is pretty cool. So you go to confirm supply, and then you'll get the confirmation. It'll be added to the liquidity pool. So I mentioned that there are some technological advances that had to happen in order for DeFi to even function. NFTs were crucial. NFTs had to be created in order for asset management to be represented on a blockchain for it to happen. Stablecoins basically had to be created in order to get enough investors into the DeFi ecosystem without the fears of volatility. So these are two main technological advancements that had to happen in order for DeFi to happen. And it's really the answer to, hey, why don't we have DeFi yet? Or why didn't we have DeFi previously? Why is it just coming about now? And basically, Ethereum cryptocurrency had to go through its growing pains. Stablecoins and NFTs had to be proven before we could start to build this ecosystem. And now we are reaping the results of what was sown in a good way. One note, talking a lot about how the traditional financial applications, instruments are being applied to cryptocurrency and cryptocurrency world. It's kind of a two-way road a little bit. There is some things that cryptocurrency is contributing to the traditional financial world, and a lot of that has to do with crypto security. So a lot of big financial institutions are exploring cryptocurrency and are actually creating their own private blockchains in order to uh, utilize the blockchain, but not make all the data public. But they are using cryptography, basically taking things straight out of the crypto playbook in order to enhance security. Another property of DeFi are the new innovations that are coming up, or something that results of the properties. So DeFi's modular nature makes it more of a sandbox than a set concept. People are constantly innovating, sharing tools to make a better decentralized application or to improve an existing one. The culture is one of open source collaboration where every project wins if just some find success because you can build off of these successful projects. So what are some of these innovations that people are creating? Take a dive into, to wrap up the course, we'll take a dive into the different types of DeFi dApps that have already proven their concept and found some popularity. The blue slide means check the chat to answer any questions. We're on the home stretch here. Looks like Joyce asked, does that mean things like DeFi savings account with a 5% interest rate is a form of yield farming? Yep. Likely what you're doing if your funds are being kept in a savings account, it's probably being used for liquidity. Like the example we went over, you're basically going through the same process, but it's being done for you. How would I convince a critic that liquidity pools is not a decentralized Ponzi scheme? Well, first of all, there's nobody at the top that is either orchestrating or specifically profiting. You don't really have people involved. And really, I guess it's only a Ponzi scheme if people expect the bottom to fall out of cryptocurrency. Otherwise, you basically have the correct amount of value represented in these pools. Eric, I don't know anything about Nexo, actually. Sorry about that. Could check that out at the end. Oh, Joyce asked a good question. In the ETH DAI example, do you only get interest if someone is trading the opposite pair, your specific pair, DAI to ETH, or anybody borrowing DAI? Vast majority of the time, it's using that specific pool. The markets, the pairs are actually divided into like separate parts of the pool. So you get interest only when someone is trading the DAI ETH pair, utilizing that pool that you added that cryptocurrency to. Mark over there had a good answer. Somebody asked me, it looked like it was a direct message, but mentioned use of yield farming. What are the tax implications for that? I actually have not claimed those coins yet, so there aren't any tax implications until I do that. Beyond that, I am not a CPA, so I don't really feel comfortable. I actually don't know how you would address that in a tax situation, but it would be a taxable event. Looks like what's the risk to the capital in the ETH DAI example? The only risk is those assets crashing in price. A lot of time, it's a fairly reliable way. If you don't think cryptocurrency is going to go to these cryptocurrencies are going to crash heavily, there isn't much risk to the capital in the ETH DAI example. It's really just a solid way to make passive income if you don't if you think cryptocurrency is going to maintain any form of value. Mark made a good point. Yeah, the earned coins are treated as income. I'm not sure if it's capital gains or if it's taxed as property, but that would trigger a taxable event. All right, onto the home stretch. So we have this DeFi ecosystem. What's actually happening with it? So what do you get when you mix decentralized technology, stablecoins, advanced smart contracts with an open source sandbox for developers? Well, you get a robust DeFi ecosystem. That's one that gives individuals true control over their financial services for the first time. This modular nature of these dApps allows for a wide variety of uses, from providing loans without a bank to the creation of even an advanced prediction market. So we're going to go over some of these projects that have been built. And we already talked about DEXs without even realizing it. Uniswap, the video that we saw, adding that liquidity pair, that's a form of a decentralized exchange, liquidity provider. So a key part of a decentralized exchange, or DEX for short, cuts out the centralized middleman that's by facilitating deals via smart contract and chain-to-chain swaps. There's also ways to wrap tokens in each other. So you could have wrapped Bitcoin on the Ethereum network. So it's just an Ethereum representation of Bitcoin. That's how the chain-to-chain swaps kind of work. The cryptocurrency is never in possession of an escrow service. It's just sitting in those liquidity pools, and the only individuals that will have access to the cryptocurrency are the buyer and the seller. There's no middleman. Fees are lower. Fees are significantly lower on decentralized exchanges compared to centralized exchanges. The platform merely connects participants using a decentralized peer-to-peer network, allowing them to trade directly through the use of a liquidity pool. Decentralized exchanges, they're not controlled by any person or group. Because there's no central authority to hack or shut down, we're likely going to see DEX development likely change to be the focus as crypto gains popularity. Centralized exchanges are always going to exist. Decentralized exchanges offer a pretty cool alternative option once you're already in the crypto ecosystem. If you're trying to get fiat for cryptocurrency, a centralized exchange is probably going to be your best option. Once you have that, though, in the form of stablecoins or whatever cryptocurrency you want, you could take that to a DEX and trade it for usually many different coins, many more different coins. So currently, the most popular decentralized exchange is Uniswap, although there's 3 or 4 that kind of jockey for position. Going back to Uniswap, let's say you provided your liquidity, but you want to reclaim it. How exactly does that happen? Just going back real quick, notice that we're not on the swap tab anymore. We're on the pool tab of Uniswap. And that's what you're going to see. If you go to manage, hey, look over there. That is our DAI and ETH that we put in. And I want to claim it, so I click remove. I want to remove all of it, so I approve the transaction. I sign the transaction. And they'll give me this, wait for confirmation. As soon as that transaction goes through, I will receive my tokens back plus interest. So it's really easy. Swap, go to swap, click remove. If you want to remove everything, you can click approve. Got to sign the transaction with your MetaMask so they actually know you have access to your MetaMask wallet and it's really your funds, because you got to get that redemption token back to the liquidity provider. Yep, and that is just confirmation. So an interesting, let's talk about the way banks make money for 1 second. A lot of times banks will offer you a minuscule rate, interest rate on whatever savings account you're going to have. Let's say it's a 0.5% yield. They're going to take your money, turn around and lend it out at an average of maybe, let's say, 10%. And they're going to take that money that they've gained. That's their profit. That's their cut. And it's significant. But if you're cutting out the middleman, you can save both the provider, the loan provider, and the person taking out a loan money on each end. Since the banks don't take a cut, you can offer more than that 5% savings. And again, since the banks aren't taking their cut, people that are seeking loans can find one that is better than a 10% interest rate. So you cut out the middleman, both the loan provider and person taking out the loan greatly benefit and save money. So that's really the whole idea behind DeFi. You eliminate the bank's role as the one that facilitates savings and loans, and you have a protocol do it instead. Protocol is going to take a lot less money out of the equation than the bank. There's some really cool wallets that are being created that are making DeFi a lot easier. So executing a simple decentralized swap takes one transaction. However, playing a game or having a browser communicate constantly with the chain, there's some wallets for that. And it's really important that these two that we're going to talk about. The first is Toshi. The second is Brave and Bat. They're both wallets that also act as browsers that can browse a decentralized web. Often they have pre-programmed dApps. They have dApps that you can navigate to. And it's really important to have both the navigation aspect, and the wallet aspect, because a lot of times you're going to have to fund these data transactions. Coinbase Wallet is a really good example of this. You might be saying, hey, Coinbase, that's a big centralized entity. Why are we talking about them when we're talking about DeFi, decentralized? Toshi Wallet Coinbase Wallet was originally Toshi Wallet. It was acquired by Coinbase Wallet, but it is not part of Coinbase.com. It's a separate thing. It's a decentralized wallet, non-custodial. So you are maintaining your own private keys, as compared to the Coinbase exchange, centralized exchange, where they are doing it for you. So Brave browser is another way to connect to the decentralized web. When it comes to dApps, Brave is one of the most intuitive out there, just because they basically took Google Chrome and said, hey, we're going to make it more decentralized. Brave is all about preservation of privacy, allowing you to share the data that you want to share and interact with advertisements only when you want to do so. And if you don't, they have an awesome ad blocker. I love using Brave. Like Coinbase Wallet, Brave has a cryptocurrency wallet that can be used to interact with other dApps or tip creators. And one of the more exciting aspects in the cryptocurrency world, if you're following things more closely, is Brave is currently implementing compatibility with IPFS, which is a decentralized storage protocol. So that's something to look forward in the future if you like the tech aspect. So despite all the promise with DeFi, I'm just going to run through. We're on the last couple of sections. So I'm just going to run through and then take questions at the end. So while DeFi is rapidly advancing, there are certain limitations that decentralized technology must overcome in order for DeFi to really take off. And most of these hurdles have to do with the blockchain-based platform that most DeFi dApps are being built upon, and that would be Ethereum. So we're going to examine some of the issues holding Ethereum and DeFi back and how that will ultimately impact the ecosystem's advancement. Mentioned earlier that a lot of these projects are limited by the platform they are built upon. Ethereum's main limitation is that it cannot process many transactions per second, like many other blockchains. This is known as a scaling problem. To put it in perspective, currently the network is limited to about 12 transactions a second, while Visa processes 1,500 transactions a second. This scaling issue must be addressed for DeFi dApps to grow and meet real-world demand. Otherwise, you're going to have another CryptoKitty situation where people go crazy for something and it just clogs the network. Like we said, this issue is known as a scaling problem, and it's one of the biggest issues facing blockchains. It's been on the forefront of people's mind for the past few years. And there are some innovations that are pretty promising when it comes to scaling. It's not a new issue. And there are multiple projects looking to solve this problem. They've been working in a variety of ways to address the limitations of the network. So the inability to scale must be addressed in order for DeFi dApps to grow. Otherwise, like I said before, get backlogs, the network cannot handle the strain that's put on upon it by extra use. A variety of solutions are being explored on this. This includes ways to improve efficiency of payment processing, or even how smart contracts function and communicate. So many have to do with adding a second layer to the network that allows for the quicker processing of transactions. There's still a lot being tested out. Ethereum specifically is undergoing a gradual transition towards what's being called Ethereum 2.0. Part of that is a move to proof of stake mining, which is going to save energy. And that could be a way to, that proof of stake model is set to make transaction throughput more efficient. So Vitalik has actually claimed that a shift to ETH 2.0 will increase transaction throughput, scaling up from about 2,000 to 300,000 transactions a second, so about up to double that of Visa. In the first couple of years, to 100,000 transactions once Ethereum 2.0 protocol is fully installed. So Ethereum 2.0, there's different stages to it. Ideally, it's going to increase the transaction volume that can be processed. Another thing that's holding back adoption is banks and market domination. It's just simply the fact that banks are so ingrained into how we conduct financial activities that, hey, it's the default. We only know that bank going to get a loan, well, yeah, we're going to go to a bank. It's just the default. So how do we break this attachment that people are used to? Well, first, you got to make them aware, and more people are paying attention to DeFi. Second, I've identified a couple things that might get people to come over to the DeFi aspect, leaving not necessarily leaving banks, but also just maybe being involved with banks, but entering the DeFi ecosystem as a transitory step. Good way to do that would be competitive rates and returns, more so than banks. That's already happening. More personal financial control, overall ease of use, and that's definitely making progress because you have tools like Uniswap. We showed you how to get money into MetaMask, or excuse me, get cryptocurrency into MetaMask, provide a liquidity pair, and then remove that liquidity pair. Additionally, more awareness is going to provide access to global markets. It could be a great way to bank the unbanked. Problem that's already being solved is lack of liquidity, and I mentioned that $50 billion figure. This was a problem. It's one that's been solved by the growth of the ecosystem, but however, new exchanges still are going to have issues with markets that aren't very liquid as they get going. But this is actually an example of a problem that's being addressed and has largely been addressed. It's one that's been overcome. Definitely less impactful than the scaling problem, which is an inherent limitation. This is just one that will be addressed in time. Got to make these things easy to use. The tools that make up the DeFi ecosystem, they're still being developed. A lot of the tools in the DeFi ecosystem, they are created with proof of concept in mind first, and then they go back and work on user experience. So you got to prove something works before you can really perfect and advance it and make it easy to use. And then you can often you go back and can create more intuitive decentralized applications. So let's say that all of these challenges are overcome. What would a world with a strong DeFi ecosystem look like? What are the potential solutions to some of these problems? Well, it's likely that dApps are going to get easier to use as the ecosystem has developed. 5 years ago or 3 years ago, it was a lot harder to use dApps than it is today. I bet you in 3 years, we're going to see more rapid advancement. It's just going to be really easy. I think that'll happen sooner than later. Things are already getting pretty intuitive. So despite all these issues, DeFi has shown a lot of promise. Let's assume that DeFi overcomes its hurdles. What can we expect in the future? Short-term, future, and long-term. Well, the more individuals involved in the ecosystem, the more it will grow. So Bitcoin transcended international money transfers, and DeFi can do the same for financial services by lowering financial barriers and borders. The future of DeFi can include extreme growth in terms of the capital locked in DeFi ecosystem. It's already got a good start with 50 billion. A robust DeFi ecosystem with easy to use tools and widespread capital availability can likely help bank the unbanked. So basically, you're looking at a situation where you can create a truly global financial system that anybody can use, that includes people that have typically been disenfranchised from the traditional banking system. And also, that's just going to include widespread availability for capital. Some people might have trouble finding the terms they want for a loan. They might have a lot more luck searching the DeFi ecosystem for more favorable terms. A lot of this is a question mark still. There's a lot to be determined, a lot to happen. There's been a rapid growth, but it's somewhat tough to say, hey, where is DeFi for sure headed? What I can say is it's definitely a thing. People have $50 billion locked up in that. People are already seeing returns. This ecosystem is somewhat built. It's going to get better. But hey, we have proof of concept already. It's working, and people are engaging, albeit they're slowly coming over. People are engaging with DeFi. That is the end of our course. Just to reiterate what we went over to really hit it home. Talked about the road from Bitcoin to Ethereum to DeFi, how traditional financial applications are being decentralized, went over the value and properties of the DeFi ecosystem, talked about some of the use cases, the applications being built upon the technology, and also talked about how to we actually showed you all how to navigate the DeFi ecosystem using various tools. That actually concludes our course. I'm going to be taking questions in the chat, answering all these questions, but if anybody doesn't want to hang around for that, I just want to thank you all for coming. A couple key things. Corey is either going to send you an email. I think Corey's going to send you an email that contains a feedback form. Just let us know how we're doing, what could be improved, what was your favorite part of the course, least favorite part of the course. Fill that out. That would be very helpful. If you're interested in getting more involved with us, I saw that Corey put the link to our ambassador program in the chat. Basically, our ambassador program, that's how you become part of our community. Ambassadors, actually, some ambassadors are working towards getting the opportunity to teach or learning how to teach these courses. So our goal is to not just educate as many people as I can. We're trying to train some teachers. Not everybody that's an ambassador has to be an instructor. It's also just a good way to get involved with our community. Sure, check out our website, check out the CCC. If you are so inclined, head over to our website. And if you like what we're doing, happy that we're doing it for free. We're a nonprofit. If you could donate anything, we'd be greatly appreciative through the support us button on our homepage or on our menu. Other than that, though, thank you all for attending. Thank you to the rest of the Blockchain Institute staff for making this run smoothly. Really enjoyed this, and I will now be taking questions. So let's see, we got anything? All right. Eric asks, is Toshi Wallet desktop or does it have an app? I actually don't think it's desktop. I think it only has a mobile app. The mobile app is pretty good. Oh, looks like we got to that one. Would you have concerns about governments trying to regulate DeFi on the basis of anti-money laundering or terrorist funding? Here's the problem. If the government wanted to regulate these protocols, how? How do they regulate it? You can't go elsewhere. You can't go after someone because it's not, you have nobody calling, you have nobody running the show. You can't go over the CEO of these, there is no CEO of these projects. So you basically have to be going after a protocol, which is a lot harder to do. You can't really shut down software, especially one that's spread across nodes. There is definitely going to be some, I mean, the IRS, the government is definitely going to be trying to monitor and track some of this. And there's, people don't know this, but the IRS is actually pretty good at tracking Bitcoin. A lot of times that when you have these centralized entities, you have to prove your identity. And there's been a couple of people that got caught doing some not so good stuff because they're trading on decentralized exchanges, and Fed enforcement was able to kind of track the activity and then go after individuals. But it's kind of tough to go over these protocols. There will be regulation around it, as Mark mentioned. There's going to be some regulation around it. You can't, it has to be all kind of indirect, kind of around it, but there really isn't any shutting down of these protocols that is likely to happen. Yep. Brian asked, what are some pitfalls to look out for as a beginner? After going through this course, it depends what you're trying to do. If you're trying to add liquidity to a pool, hey, just reference this course. It's not going to be too hard. If you're a beginner, I wouldn't get into the tougher financial, the tougher, more advanced financial aspect of DeFi. There's some crazy margin trading, leveraging loans, basically using your redemption tokens as leverage. It can get pretty confusing, and I don't even know the first thing about that. So I would just stay away from that if you're a beginner. It's something that can be worked up towards. Any other questions? I'm gonna hang out for a minute. Notice some people are probably exiting as this is the end of the course. So yeah, I just want to thank everybody again. It has been fun. Looks like Blockchain Institute, looks like Corey put the forum in chat for feedback. Would love, again, for you all to let me know how I did, but otherwise I'll stay here for a couple minutes.
Is that okay to ask about a little more about the ambassador program?
Yeah, definitely. Do you have any specific questions or just want to know about it?
If I don't want to teach.
Oh, so basically we have ambassadors and instructors. And if you're an ambassador, you don't have to be an instructor. Ambassadors are just members of our community. We have our own Discord. Ambassadors also get some perks as well. They get say in what content we produce, as well as a preview of it. For example, this is like the third or fourth time that we've run through this. Actually third time. The first couple times were for first time was for ambassadors. So you get a preview of some information, you get to stay up to date and stuff. It's not a huge commitment. It's nice to just kind of stay up to date with us, but yeah, not everybody who's an ambassador has to teach. We're not going to make anybody do something they feel uncomfortable about.
So what is the responsibility of the ambassadors?
Really, it's just a community. It's definitely, I don't know if responsibility is the right word. It's more of an opportunity to get access to advanced materials, just be part of the ecosystem. We have a Discord chat room where we post news, events, priority for events, that type of thing. So it's not a huge responsibility. It's not something that is going to take up a significant amount of your time. It is a way to be involved with our community and stay involved. All right. Thank you, Joyce. Any more examples of yield farm or DeFi savings account platforms? We use Uniswap. There's a couple more. Let me pull up DeFi polls because there's always a measurement of who has the most locked up. Compound and AAVE, I think AAVE is Aave. are also similar to Uniswap. Uniswap is actually right now in terms of liquidity fifth. Sushi Swap, Aave, Compound are all excuse me, Compound and Aave are lending. Sushi Swap is like Uniswap. It's a decentralized exchange. So yeah, if you wanna check out another one, I'd recommend Sushi Swap or something like Balancer on the Ethereum network.
So I'm trying to fill out the ambassador form and it's asked for the subject. So I'm a little confused.
As for the subject,
Yeah, I know. It says apply today and then it says subject.
let me look at the ambassador.
I guess I'll just put ambassador. It's just very strange on the form. I just figure I should let you know.
Yeah, you can just put subject or anything in there, or put ambassador application.
Yeah, that's what I did. Are you guys going to teach classes on the smart contracts?
We are thinking about it. Right now, our next course will have to do with NFTs. We might be doing something with smart contracts soon. Best way to stay up to date with that would be, yeah, joining the ambassador program or a newsletter.
And where are you located, if I may ask?
We are based in Chicago, but we are a somewhat spread out team.
Cool.
But yeah, headquarters is Chicago. Oops.
And is this your full time or are you doing some development?
I am not a developer. Code scares me. This is my full time. I basically just teach people about the concepts, get them ready for if they do want to code or are developers. Okay, you know the conceptual thing. Now you can actually build.
Nice.
Yeah, it's definitely pretty fun. All right. Using the ETH DAI example, Edward has a question. Using the ETH DAI example, I'm bullish on ETH and plan to hold. However, I'm wondering if the risk to capital is if DAI goes down. Remember, DAI is a stable coin. DAI specifically set to $1. There's not much risk of DAI going down without ETH crashing. It's a pretty robust and resilient ecosystem. All right, it looks like the questions have dried up, so I'm going to thank you all.
Upside, anyway. How did you get into blockchain, if I may ask?
Oh, honestly, a friend just, I had no idea about any of this stuff until 2016. When a friend sat me down and told me about it, I'm like, this is really weird. I haven't heard of anything like this before. Can this even work? You know, and I just dove in more and more and started researching. And then we ended up ultimately starting a project that would become Blockchain Institute. And yeah, I've been on the ride ever since.
Nice. How old is the Blockchain Institute?
We were working on a project a little bit before that. Blockchain Institute became an entity, I believe, in March of 2018. Well, that's when we received the nonprofit. So we were organizing a little bit before that, but yeah, that's when we received the nonprofit status.
Is that okay to connect on Telegram?
Do we have a Telegram?
Uh-oh. Okay.
I would recommend that if you have Discord, join our Discord or apply to be an ambassador and join our Discord.
Okay.
yeah, we do not have an active Telegram right now. Yeah, Discord is a little bit better for us and what we're trying to accomplish.
So I did apply. I filled out that form,
Okay.
but there's not much to it.
Oh yeah, I mean it's not. Let's put it this way: it's not a very rigorous application process. It's just yeah.
So at some point I'll get an email saying I was accepted or rejected or whatever.
Yeah, definitely.
Okay.
We'll follow up with you and basically instructions to the next step, which would be joining the Discord.
Okay.
Yeah.
Cool. Okay. Thank you so much.
Well, thank you.
Have a great day.
You too. And that goes for everyone else as well. Looks like people are filing out. One more thank you all. It's been fun. Hope everyone has a good Friday and a good weekend. Thanks.